All right, so this is problem number 12 on your homework, and this is going to relate to a contingent liability. This is the McDonald's case. And so they talk about, again, they were famous for serving hot coffee. And says, after a famous case involving McDonald's, the lawyer for Buzz, this again, the coffee shops, warned management during 2014 that it could be sued if somebody were to spill hot coffee and then, of course, be burned. They said, with the temperature of your coffee, I can guarantee it's just a matter of time before you're sued for $1 million. This, again, was their attorney. This, again, for the Buzz company. Buzz felt the likelihood was remote. It says, unfortunately, in 2016, the lawyer's prediction came true when a customer filed a suit. After consulting with his attorney, Buzz felt the loss was possible, but not likely or probable. Again, this is their judgment. The case went to trial in 2017, and the jury awarded the customer $400,000 in damages, which the company immediately appealed. Buzz, again, felt a loss was probable, but believed a lower amount could be negotiated. During 2018, the customer and company settled their dispute for $150,000. The question here is what would be the proper recording of this, again, this contingent liability each year from 2016 through 2018 under the GAAP provisions? So remember, you got the remote, possible, reasonably possible, and probable types of likelihoods. So down below is you have to check which of these statements, again, are true. So the first one where it says Buzz must disclose in a note to the financial statements that a potential liability exists because the liability is possible in 2016, that would be true. Part 2 says Buzz must disclose the liability in a note because the trial judgment makes the likelihood of a liability probable. It says, however, the amount of loss is still not can't estimate it because the lower amount is expected to be negotiated. So that's true. They still must disclose it. On this one, it says they must record the loss and the liability because the out-of-court settlement made the $150,000 loss certain. That's definitely true. So the first three would be checked as true statements. The last one are going to both be not true because anytime something is remote, again, this was in 2017 and if that was the case, you don't have to disclose anything or accrue anything if the probability is remote. So that's why the last two, again, are not checked. All right, and I think that's it on number 12 on the contingent liability. All right, number 13. On this one, they want you to do some amortization of your discount. So they tell you, first of all, that you issued a $600,000 10-year 5% bond on January 1st. You got to do the entry. They're issued at 580. So, 580 is what they got. So if the face is 600, that's going to be a $20,000 discount. Interest is payable on December 31st using straight line amortization. They want the journal entries for essentially the issuance and the first interest payment. So the issuance right away, they debited cash for 580. That's what they received. Notice bonds payable is always credited for the face amount. So there's where that 600,000 is. And then, of course, the difference would be the discount. Now, to do the amortization, again, you got $20,000. You're going to be dividing that over the life of the bond. So that that 20,000 will be divided by 10 when you do that amortization. All right, so on the interest expense, and I'll show you the calculation down below. On the interest expense, remember, first of all, the amount of cash you paid is the same no matter if it's a premium, a discount, or a face amount bond. So that 600,000 face times the stated rate times 12 over 12 would be exactly how much cash you're going to be paying, which is 30,000. The amortization part is right here. The 20,000 divided by 10, that's how you amortize it. It's going to be $2,000 per year. So you're essentially, because you start off with a debit balance on the discount, to amortize it, you're going to credit it. So they credit that discount for the 2,000, again, 20,000 divided by 10, and then your interest expense is just your plug number. It's going to be 32,000. You have to take the cash paid plus the amortized discount equals your interest expense. And that's it. That's how you do it. All right. So that's how it would work with a discount. All right. On number 4, again, almost same type of problem. Again, they want you to do the issuance of the bond and the interest payment. These bonds are $800,000. They sold for $741, so that difference is the discount. That's a $59,000 discount. You've got interest payable annually. Always look and see how often they pay the interest. On this one, though, they want you to use effective interest rate method, not straight line when we do the amortization. So in that one, you'll do a direct calculation with the interest expense, and then the amount that you amortize will be the plug number. So again, with the issue, the journal entries on the issuance, and then of course the payment of interest. Of course, we need that market rate on 6% because that market rate, that's how we're going to calculate the interest expense using this method. So it's going to be the market rate times the carrying value to get that interest expense on part 2. And again, I'll show you that down below. All right, so remember, stated rate's 5%, market rate is 6%. So the issuance of the bond, they debited cash for how much cash they got, debit 741. Always credit bond payable for the face. The plug, the difference is your discount. That's $59,000. So then when you go to calculate the interest, so remember, your initial carrying value would be that 741, right? So your initial carrying value is your bond, and it might help. Let me write this out real quick, just because you just did a couple scenarios where you did your carrying value presentation. So remember, the carrying value will be your bonds payable at your face amount, which in this case is $800,000 minus your discount. So the initial discount on this bond again was $59,000. So if you subtract that, your initial carrying value is $741. So again, just to show you that calculation, they show that right here, but I'm just emphasizing that because this is what you need to calculate your interest expense. So if you take that times that market rate of 6% times 12 over 12, or just times 1, that would give you interest expense directly of $44,460. Notice that's the amount you would put as your debit. Your cash payment of $40 would just be your face amount right here. It's your face amount times your stated rate, again times 12 over 12. So that amount is, the way you calculate that is the same no matter how the bond is issued. So both the interest expense and the cash payment are direct calculations, and then this credit to the discount on bonds payable, that then becomes just a plug number so that your debits equal your credits. All right, so the journal entries are the same whether it's straight line method or effective interest rate method, but the way you calculate the interest expense is different, and hopefully you can see that on this particular problem. All right, so I think that's it on my comments on number 14. All right, now number 15, let's look at what they give us. It says the following amortization schedule indicates interest and principal that Chips Cookie Corporation must repay on an installment note established on January 1st, 2018. CCC has a December 31st year end and makes the required annual payment. So again, they're showing you what the beginning note payable is, and then of course you've got the interest expense, the repayment of the note, and of course the ending value of that note. I think down below you can see some of the calculations. And then there's a little hiccup on my computer. Let me pause this for a quick moment. I will come back to this, then I'll reset it. Hold on just a second.